Hello guys, welcome to all of you here to joining with us. And today we have the Don Avinam Piduguralla. He is a specialist in finance and he has done many certification in AI and Python and so many. He is very keen to interested to know to learn the new things and new challenges and spreading all his knowledge to the audience. So just let it be patient and learn the good opportunity from him. Abhinav down, and I will request to Don Abhinav to do the further for this webinar to be successful. So thank you so much, Don Abhinav, for you to taking the for this session. Thank you so much. Yeah, now we will start now.
Thank you, Jitendra ji, for your kind words. And hello, everyone. How are you all doing? Welcome to today's session on monetary and fiscal policies. So, whether you're a student, a professional, simply curious like me, and want to know how our economy works, this lecture is designed, to help you understand these crucial concepts in a simple and in an engaging way. I'll use many examples, and by the end of this session, you'll have a clear grasp of what monetary and fiscal policies are, and you'll know how they work and why they matter at all. So before I started telling you what monetary policies and fiscal policies are, I want to tell you about the prerequisites of those topics, like understanding about inflation, repo rate, reverse repo rate, deflation, etc. So let me share you my PPT and we'll get started with the lecture. Okay, yes. Can you see my PPT?
Yes, we are able to see. Yes. Yeah.
Yeah, okay. So let's get started with this monetary and fiscal policies. So basically, before starting this monetary policy, I want to tell you the prerequisites that you should understand, which means the basic concepts in monetary policy. So the first one is inflation. Inflation is generally, it's a general price increase in prices and fall in the purchasing value of money. And all these basic concepts, most of you might have know this, but I'm just telling this so that those who don't know will understand it or get a clear grasp of somebody who have already know. So when inflation is high, each unit of currency buys fewer goods, less goods and services. Like for example, if the inflation is 5%, something that cost 100 rupees last year will cost 105 rupees this year. So an opposite to that is deflation. Deflation is the decrease in the general price level of goods and services. It increases the value of money. It means you can buy more with the same amount of money. However, deflation is a little problematic. It might indicate a reduction in demand. So something reduction in demand is not, said helpful or it's a good thing. It's not. And we'll talk about interest rates. Interest rates is very important to understand. It is the rate, cost. It is a cost of borrowing money or the return on savings. Suppose you take a loan, the interest rate will determine how much extra you pay back and the addition to the principal amount. For example, if the interest rate is 5%, the interest rate is 5% if you're borrowing 1,000 rupees, which means you should pay back 1,050 rupees. So, and then we'll go to repo rate, reverse repo rate, and cash reserve ratio. So, repo rate is the rate at which central bank lends money to commercial banks. So, who are these commercial banks? Like, there are many commercial banks like HDFC, IDFC, and many they are commercial banks, right? So the RBI lends money. RBI gives money to these banks at an interest rate. And that rate is repo rate. And that repo rate will influence the cost of borrowing for banks, which affects the interest rate they charge to consumers and businesses. They give loans to consumers, right? And also to businesses. And the reverse repo rate is exactly the opposite of repo rate. No, it is a rate at which the central bank borrows money from commercial banks. It takes money from the commercial banks. The RBI takes money from banks like HDFC, etc., etc. No, it helps the central bank manage liquidity in the banking system. And there is this thing called CRR, which means cash reserve ratio. It is the percentage of banks' total deposits that must be kept in reserve with the central bank. It influences the amount of money banks have available to lend. So the bank should have some amount of money or gold to be kept as a reserve. That amount should not be used to lend to its customers like us. We take loans, right? So that banks cannot give loans with that amount of money. So they keep it like a reserve. So now we'll talk about objectives of monetary policy. So why we use monetary policy, for what purpose the RBI uses monetary policy? The main thing to is to control the inflation. Controlling inflation was the major thing. Sorry. So inflation, I have already told you, is a general increase in prices and fall in purchasing value of money. So it is the primary goal of monetary policy. The RBI tries to keep prices stable. No, the prices need to be stable. It is the rate at which general level of prices for goods and services rise. It also erodes the purchasing power. So the RBI aims to keep inflation in check. Inflation for what? To ensure your money retains its value over time. And then it also manages employment levels. What is the main goal with this is to increase the employment levels. The RBI's goal was to increase the employment levels. It cannot decrease it. Sometimes our actions may lead to decrease in employment that I will talk about later in this class. The main goal was of monetary policy is to increase the employment levels. The RBI strives to achieve high employment by how it influences the economic conditions, and the central bank can help to create a good environment for job creation and reduce unemployment. Its goal is to reduce unemployment, economic growth. So it is another major goal. It is to foster a healthy economy. We need a healthy economy, right? By adjusting monetary policy, the RBI can promote sustainable economic growth, ensuring that the economy expands without overheating. We need our economies to grow. Okay, now I'll tell you an example. Let me clear this. So with this example, you'll understand about monetary policy in a better way. So imagine economy is like a car. This is our economy, right? If it is moving slowly, that means it is in recession. If it is moving slowly, then that means it is in recession. Then what will you do? If your car is moving slowly, you press the speedometer to go fast, right? Same like that, the RBI will push the speedometer, and that speedometer is interest in lower rates, lower interest rates. The RBI is going to lower the interest rates to speed up the economy. So here, when you speed up the car, it goes speed, right? Same like that, the RBI lowers the interest rate. It decreases the interest rate so that our economy can grow faster. I hope you understand it. And if it's going too fast, if your car is going too fast, like 100 kilometers per hour, then what will you do? You will apply a brake to it so that you won't meet up with any accident. So what will RBI do at that particular time when our economy is going at high inflation? It will press the brake, and that brake is raise in interest rates. It increases interest rate, and that is a brake to slow our economy. So I have explained you about repo rate, reverse repo rate, and cash reserve ratio, which the bank keeps as a reserve of some amount of its money. And statutory liquidity ratio, it is the minimum percentage of deposits that banks must maintain in form of gold, cash, or securities, which means stocks or something, and which influence the lending capacity of banks. So there is a thing called open market operations, which you can see it in here. The open market operations. So the open market operations involves buying and selling of government securities, yeah, in the open market only. So when the RBI buys securities, it injects money. It injects money into our economy. When it injects money into our economy, it increases the money supply. When it sells securities, it takes money out of the circulation, which reduces the money supply. So I'll tell it with an example. Suppose I am the RBI and you are a citizen. I will sell you a note saying it's a security and you will give me 100 crores of rupees. I will give you a receipt saying that you have gave me 100 crores, and for that I will give you interest every year. You gave me money, right? So for that money I will pay you interest. So when I take money from you, the money circulation will be less, which reduces the money supply in our economy, right? If I take money from you, uh, you will expect some interest. With some expectation in interest, you will not spend that money and you will give that money to me, which makes money supply less in our economy, which lowers purchasing of goods and services by you. If you purchase some goods, the businessman purchases another goods. That's a circle which goes on and on and on. Okay, and that's called open market operation. If I sell those note to you, like if I give you 100 crores back and take that note from you, you will spend that 100 crores. If I give you 100 crores and take that note which I gave to you, then you are most probably going to spend that money, right? And that is open market operations, which it is used by RBI and it's a part of our monetary policy. Yes, RBI increases open market operations and decreases open market operations sometimes. When it opens, it injects additional liquidity into the financial system. And we also talked about repo rate. So in January, the RBI reduced the repo rate from 6.5% to 6%. So when it decreases the repo rate, it aims to stimulate economic activity. So there's a global economic slowdown, there is recession going on, right? So that RBI has decreased repo rate. So when RBI decreases the repo rate, banks can borrow money for lower interest rate. When banks borrow money at lower cost, which which they use to lend businessmen and consumers like us at lower interest rates, which stimulates the economic activity. So for that reason, the RBI has decreased the repo rate to 6.5% to 6%. Okay. Hello, Jitendra. I think we both are
Yeah,
only there here.
yeah. So we
And
can finish this year like whatever we have the contents, then we just
yes,
will complete it, and then we'll have this some based on the some question and answer. Then we'll wind up. Yes.
okay.
Yeah.
So we completed discussing about fiscal policy and we'll go to, no, I'm sorry, we completed discussing about monetary policy and we go into fiscal policy now. So before understanding fiscal policy, you should understand some basic concepts in fiscal policy which we'll talk about. So some of the basic concepts are debt, national debt and budget deficit. It is budget deficit, public spending by the government. So we'll talk about these three first. So what is a budget deficit? Budget deficit occurs when the government spends more money than it takes in through taxes and other revenues. Uh, I'll explain it. So if the government spends more money than it earns, and that's called budget deficit. To cover the deficit, the government borrows money from whom? From international banks or from citizens like us, which adds to the national debt. Our national debt increases. So, for example, if the government spends 100 crores, if the government spends 100 crore rupees, but it only collects 80 crore rupees in taxes, so the deficit is 20 crores. I hope you understand it. And we'll talk about national debt. It is the total amount of money that a country's government has borrowed and not yet repaid. Remember this. The amount which the government has borrowed and not yet repaid. No, it's the accumulation of budget deficits over time. So, for instance, if the government borrows 20 crore rupees each year for 5 years, the national debt will be 100 crores. And then public spending is done by the government itself. It is the money spent by the government on public services and infrastructure. It examples like building schools, hospitals, roads, and providing social services like pensions and unemployment benefits. All these three come under public spending itself. So, let's understand the basics of fiscal policy. It involves the government spending and taxation to influence the economy. So in India, the Ministry of Finance is responsible for designing and implementing this policy. The monetary policy is applied by the RBI, but the fiscal policy is applied by the Ministry of Finance, which is headed by Nirmala Sitaraman, who is our finance minister. So let's understand what are the objectives of this fiscal policy. So the main objective was economic growth. We need our economy to grow, right? It stimulates the economy through strategic spending. So it means the government can stimulate economic growth by investing in infrastructure projects, education, and healthcare. These investments create jobs, right? If you invest money and build a school or a hospital, it definitely gonna create many jobs, right? That's how the government will stimulate the economy. While monetary policy is managed by the central bank, fiscal policy is controlled by the government, which is the Ministry of Finance itself. And its another goal was to reduce unemployment by creating jobs through government projects. and public services. Fiscal policy will help lower unemployment rates. Like when people are employed, when people have jobs, they will spend their money. They will spend money which boosts the economy. So, and its another goal is to manage inflation. Uh, it helps to control inflation by adjusting tax rates and government spending. Like, for example, increasing taxes or reducing government spending can help cool down an overheated economy. So, I have already told you the two tools for tools for fiscal policy are government spending and taxation. Government spending and taxation. So, let's move forward.
So, Donna, we have a question here. So,
Yes.
government having this some kind of a scheme, right? Like which will be benefited to the individuals or the kind of doing this some business or kind of the, to know create a jobs. So, do we have like a, what kind of schemes we have related to fiscal policies by the government?
Yes, I will explain it.
Yeah.
So before that, I will complete this example of fiscal policy. And then I will tell examples of monetary and fiscal policies which are implemented by our government. So this is an example for fiscal policy. It makes you understand about it much clearer. So imagine our government as a gardener. We have a garden, and for that garden, the government is the gardener. The government plants seeds, right? When government plants seeds, that means that it spends money. It is spending money on projects like infrastructure projects, schools, building schools, and hospitals, etc. And it waters them.
Come
It is
also,
like watering.
can you come also just to like it will be audience also will be seeing that like to way of to know they will learn also to know to explanation and the descriptions of the parts. If you come video mode, then it will be good for others also.
On video mode.
Yes.
Okay. Yeah, okay. So what have I told you? Like, so if the government is gardener, it plants seeds. As planting seeds is like spending money on projects, and watering this garden is like having less taxes, less tax. So it helps the economy grow, right? When you plant a seed and when you give less taxes, it will improve our economy. It will, when the garden becomes too lush, I mean, if the garden grows bigger, it has long grasses. So what will you do? Any gardener would cut the grass, right? Anybody would have do that. So the same our government will do when the economic garden becomes too lushy, which means the inflation has increased very high, the inflation has skyrocketed. Then what will our government do? Our government will cut it, like increase in taxes. When inflation increases, government will increase in taxes. Government will reduce in spending. When you don't spend amount, the inflation will not increase. Why will the inflation will not increase is because the demand is high. When you don't spend money, when you don't stimulate the economy, the demand decreases, which lowers the inflation rate in our economy, so that the government does this thing. And we also talked about budget deficit, national debt, and all that. So we'll talk about how monetary and fiscal policies work together. The government will implement, right, many policies, and these are two main policies, and these two policies will work together in our economy. Like it is the monetary policy is handled by central bank. Fiscal policy are used by revenue to generate. The RBI cuts the interest rates, making loans cheaper, while the government increases spending on infrastructure projects to create jobs. This coordinated effort helps stabilize the economy and uh, and promote the recovery. So now we'll talk about few examples of monetary and fiscal policy. One second. So we'll talk about the real world examples of monetary and fiscal policy. Before we had this, Bharat Vikas Yojana, which I will also talk about. So first, let's talk about monetary policy examples. In February 2020, at that time we have recession, right? In February 2020, we had this COVID thing, and we had a global lockdown, and we also had a recession then. So at that time, the RBI reduced the repo rate. The RBI reduced the repo rate and the CRR, cash reserve ratio, which means the bank should hold some amount of money uh, with them, and that has been decreased from 4%. What have I done? So, okay, I'm sorry. I will. Okay. So the cash reserve ratio has been decreased from 4% to 3% in 2020. So for a period of 1 year, for 1 year, our cash reserve ratio at banks was just 3%. So why did the RBI did this? This measure released about 1.37 lakh crores of liquidity into banking system. So giving banks more money to lend, which helped boost economic activity. Like when you decrease the cash reserve ratio, you can hold less amount of cash in the banks. So when you can hold less amount of cash, you will have some more amount which you can lend to others, like customers like us. So how much money has been released by decreasing that amount is 1,37 lakh crores. I'll be sharing you the notes of this lecture so that you can refer. You can also read it again with all these examples, basic definitions and stuff, all that. And throughout the 2020, so in the March 2020, the RBI reduced CRR from 4 to 3%. And in February, it reduced repo rate. I've told you that the repo rate has been decreased, but I didn't told how much. The repo rate by 25 basic points. Like from the repo rate has decreased from 4 point decreased to 4.90 from 5.15%. So this was done to make borrowing cheaper for banks. So when you decrease the repo rate, the banks can borrow amount for just less interest rate, right? When you decrease the repo rate, the banks can borrow money from the RBI at less interest rates. So, which in turn would lower the interest rates for consumers and business. So, when banks take money from RBI at lower interest rates, it also gives uh, loans to our customers, like common people like us, for less interest rates itself. So this measure released so this was done to make borrowing cheaper, and it helped to stimulate our economy a lot. So like throughout 2020, our RBI has conducted multiple open market operations too. I've told you about that open market operation where you sell a token and receive money, you know, by purchasing government securities. So this is called a security token because it is secured by our government. CMO, which is called OMO, which is called open market operations. Throughout 2020, the government has done this. So by purchasing government securities, you can it injects liquidity into the banking system. This helped maintain liquidity and ensured that banks had enough fund to support lending and investment. So there is this thing called targeted long-term repo operations, which is very important. Targeted long-term repo operations. So in 2020, the RBI introduced this, which is called TLRO, which means targeted long-term repo operations. So why did the RBI introduce this? To provide long-term funding to banks at the repo rate. And banks were encouraged to use this funding to invest in corporate bonds, like in commercial paper and non-convertible uh, debenture. And this helped improve liquidity in the corporate debt market. Liquidity means nothing but more supply in money. Okay. And I'll tell you some examples of fiscal policy now. So in response to COVID-19 pandemic in 2019, the government has introduced many schemes here. I'll talk about it now. So Indian government announced the Atmanirbhar Bharat. You must have known that, right? At the time of COVID-19 itself, which means Self-Reliant India campaign. It introduced in May 2020. So it includes 20 lakh crores. It includes 20 lakh crores economic stimulus package. And here we aimed like to support various sectors like including MSMEs, which means micro sector, macro medium sectors, and agriculture and healthcare. And we provided direct cash like to poorer sections of our society. We sent money, the government sent money to the poor people directly to their bank accounts. It supplied free ration and all that stuff. And that is a part of fiscal policy, and we do it to stimulate the economy. Mhm. And there are few tax reforms in 2019. Those who study tax must have known that
So,
in
for
2019 we had.
for interrupt here. So we have here just 2 minutes for that, and then the session will be wind up.
Okay.
So thank you so much for your outstanding session on the fiscal policies, and it is good to learn for everyone to know about that skill enhancement and skill improvement, and it will work for the audience to get their careers improvement and in the high success on that any particulars financial economics or any career growths. So thank you so much, Donavina, for your valuable time with us to giving the very good session to us. So
Yes.
thank you so much again for that.
Thank you so much, Jitendra ji, for giving me this opportunity. And all of you who are watching this live on YouTube and the recorded session. Thank you so much for watching this. I hope this
Yeah.
will help you. Yeah. Thank you so much.
So definitely, and
Bye.
just contact us for any kind of any help or any kind of your learning activities you want to improve with the Donavina. And we will be sharing with you all the kind of details of the social media links, and you can contact and you can approach to Donavina to get the your skills, because you are investing money in your skills. Definitely, it will be double and triples. The bonds will come from your back to your life and your get success. Thank you so much again. Yeah.
Yeah.
Bye.
Thank you. Let's meet
Thank
later.
you. Thank you. Bye. Thank you.